Hello, welcome to the channel. Today we're going to be diving into Citi Group, the stock. We're going to be looking at it more in depth from a investing perspective, mostly, right? If you're more of a trader, hopefully you can still pick up information about the stock in this video, but this is more geared towards an investing more in like the 3 to 5 year outlook. So first thing I like to do whenever I look at a stock, I like to look at the 1 year, all right, the 5 year, and then the all time. First thing you're probably seeing is, whoa, this, right? So it is, 15 plus years ago. But anyway, that's what my eyes are drawn to. But yeah, I mean, it looks relatively flat, but actually since 2009, 2010-ish, it's actually gone from 33 to 62, so not quite doubling, but for a bank, it's not too crazy. Now let's look at PE and forward PE. It is a bank, by the way. I'm not going to dive too deep into what they do because I'm assuming everyone watching this video knows what a bank is and does. So this is why it's important to look at PE and forward PE, right? Because there's always things that impact the stock, and it's also important to look more in depth and why there's a gap here. Maybe they're projecting. It looks like they just had a poor quarter in quarter four. Probably that they're expecting because they actually beat in it. And their growth is, at least quarter over quarter. That's significant. That's like 40%, right? Is that quarter four? Yeah, the quarter four. So the quarter four of this year is expected to be much bigger. So that's probably the value in this. Although you have to look a little bit more deeply usually because maybe there is debt they're writing off, or maybe they got a tax break from the government. That's fairly rare, but it does happen in the cases of like Intel or AMD, for example. I guess they do the same thing, but Intel has been getting money from the government. It's not really doing too great, but AMD is also writing off a lot of debt with the merger of Xilinx. So their PE is 200, but their forward PE is 45, right? Which is still a lot more reasonable. So this looks like really low PE and forward PE because I think the S&P 500 is, I know it's in the 20s. I thought it was in the lower 20s, but I heard more recently that it's actually in the upper 20s. But either way, this seems cheap. However, for banks and financial institutions, this is relatively average. Morgan Stanley's up around 17. I believe Bank of America is around 13. Wells Fargo's around 11. Forward PE is right around this range. So if we're taking the forward PE, this is on the cheaper side for sure. But it's not like, like a tech stock at 10, right? Usually if a tech stock's at 10, it means they're not growing at all. So, all right, we looked at that. Now, important to take our eyes on this right here, annual dividend yield, 3.62%. And they raised recently as well. I guess one thing I'll dive right before into that is I like this a lot. Beat. That is great. I love that generally because then that means looking ahead, you can take their word for it, right? Of course, they may miss, and they're going to miss in the rest of the history of their company, of course, right? Usually when a company is consistently missing, right, it means one of two things in my perspective, right? I guess one of three. The third would be the least important, is just something they were not expecting to happened, right? But usually that's only a one outlier. That's not a consistent pattern. So if there's a consistent pattern of not hitting their expectations substantially, either means A, they're lying to you, right? They're trying to like make it look better and then hoping they hit that, right? Or two, they don't know their business well. Because if they beat consistently, it doesn't necessarily mean they don't know their business well. It may mean they're being conservative, which is actually good, right? I'd prefer the company to say, hey, we're going to do this, and then they do that. I mean, this is a bit extreme example. I mean, that's by significant percent. Like, this is pretty conservative, right? But, like, generally, I would much rather have the company, aim low and beat rather than the other way because, stocks start falling. It's a little bit more uncomfy, but it really doesn't matter that much. Anyways, that's my whole rant on that. This 3.62% dividend yield, I like this a lot, right? Because it gives you flexibility in the way you can use the company, right? So I went over, I think, Wells Fargo and Bank of America, and their dividend is both under 3%. One I think is about 265%. The other is about 285, which is fine. That's not bad. But I like this stock. All right, obviously this is weird, right? And we need to do more research. I mean, obviously the financial crisis. We know why it fell so dramatically, right? And regulation on banks is a lot bigger, which is both good and bad. The good is that you're probably not going to get rug pulled like this, right? I can't even imagine. I've never had losses anywhere near this much in a stock before. You're not going to get rug pulled, right? As much, but also this run, right? The run from 61. Well, I mean, look at this. From 94, the end. So basically 95, 53 to 4 or to 500. I mean, that is in over 5 years. That is insane. You will never see that in a bank. A bank of this size. I mean, their market cap right now is 100 billion at 60. So that means that was like 600 billion. That's insane, right? And I'm sure they were making money with that too. You will never, ever, ever, you will never see a bank this size in America run up that dramatically again. Not in the next 50 years. I do not think so, right? So they do have a sitting cap, but I do like this stock specifically in a way, right? I like it in a dividend portfolio, meaning, hey, I'm going to buy dividend stocks in this portfolio, right? But also beating inflation, right? So there's all kinds of dividend stocks, but personally, I only really see, I hate to say only see value, but the two that I like and that makes sense in my brain, right? There's two different kinds. One is the high dividend, maybe 5, 6, 7% yield, right? Just trying to get as much out of it as you can. And then the other one is one that gives you a good solid dividend yield, but also is going to match or beat inflation, right? That's what I'm personally looking at. And I'll tell you why. Because one, you don't really, other than moving some stocks around, okay, this is kind of a loser stock. Oh, this one really overperformed and its dividend has fallen maybe I'll sell a little bit, right? And move it around. Other than that, there's really not a whole lot of work you have to do for it, right? And so, like I said, it looks flat, but actually, let's just take 2010, right? Somewhere in that 40 to 30 range, right? So, and if we look at inflation, I just got a very simple inflation calculator. It's literally usinflationcalculator.com. So I'm assuming it's genuine, right? Technically, I don't know, but I mean, that's what the website's meant for. So if in 2010, inflation has increased 44%, right? And clearly if you take, even if we take its highs in 2010, right? Looks like it peaked at, I guess it peaked at 50, right? But I mean, that looks like the tippity top. It technically wouldn't have beat it then. But if you take the average, which would be about 45, right? I don't know, let's just do it. 45 times 1.4. Yeah, about exactly. So this is going to match this stock historically, right? And that's if you timed it not perfect, right? If you could time it much lower than that, you could have bought it at 25. You could have bought it, I guess we're doing 2010. You could have bought it at 37. You could have bought it in 2012 at, 29. You could have bought it here at 39. You could have bought it here at 62. That's weird. That's not what the graph shows. I guess I'm looking at here and not there. They're at 39. They're at 40. And this is much more recent since 2020. I know inflation was bad, but it wasn't 40% over. I mean, in some areas it is, but not generally, right? So this is a stock that will pay out a solid dividend at 3.5%. And is generally, or has the track record over the last 15 years of beating inflation. So I personally would, it depends. Maybe I like Morgan Stanley better. I know it's not a traditional bank, but it's a financial institution. I like it a bit better. It actually pays the same dividend and has a much better growth record over the last at least 10 years. I don't know about 15 off the top of my head, but this one is one that fits. And if you like it, if you like banks, if that's sort of your thing, or if you just want you want a really, really diversified dividend portfolio and you want like 200 stocks like that, right? Just for, diversification. This is one you should look at. This will do the job. This will match inflation. Not 100%, right? Nothing's 100% stocks, but historically over the last 15 years, which seems to have been a different era, right? You can say this is an era, this was an era, this was an era, this was an era. This is not an era you want to be a part of. But since 2010, right, this is going to match inflation. It's going to pay a solid dividend. It's not going to like utterly collapse. I mean, anything can, but it's not in the sense of, like a risky, non-profitable tech startup, right? IPO. It's not going to, rug pull on you in that sense. Or like when the market in a recession, this thing isn't going to utterly collapse. So that's what I like the stock for personally. And if you like investing in dividend stocks, this is one to look at. This is one, I like some mix of both. And like I said, I do like Morgan Stanley better if you just want one financial institution. But if you want multiple, this is definitely one to look at. I like it personally right now. Today, this date was October 2nd, 2024. I like this over Wells Fargo personally. This isn't investment advice, of course. I'm just here to talk and provide information and do a basic outline. I guess before I wrap this up, let's take a look at some analysts. I hit financials, which is fine, but we just don't have time for that, right? Analysts, hello. I did not hit news. Beating, love that, right? So generally, more people say buy. It's gone a bit up and hold, and a few people say sell. But I mean, actually, it's almost the exact same that say buy. It's just a higher percentage. Suddenly, random analysts popped out of nowhere and started giving their opinions on this. Or some people must have jumped in and out, right? Or is this when people change? I have no idea. I don't really care what analysts say because they're usually consistently wrong. And if they knew everything, you'd just follow what every analyst said, right? And just do exactly what they thought. If they say buy, you buy, and if they say sell, you sell, right? And they almost never say sell. But they're okay. It's something to factor into the bigger picture of the stock, right? If everyone says this is horrible and you think it's great, you should question it. If you think it's, and if they, or vice versa, and if they agree with you, you just, basically say, aha, I knew I was right. But anyways, there's a decent price target of 72. It's nowhere near it. So if this is your thing, factor that in. Let's take what Schwab says. They give it a B. They like it. This is a 1 year. Yeah, this is a 1 year outlook. And they actually just reiterated, that would be literally 5 days ago, as of the making of this video. They give it a top 12% performance of, I believe it's just share price. So they don't even look at dividend. So if you like Schwab and then you think they're 100% trustworthy all the time, you should absolutely buy it. I disagree with this slightly. Like I said, I think this is a great dividend stock. I'd put it more towards a middle performer personally. It could shoot up quite a bit. Cool. But I don't see any evidence that, oh yeah, this is really undervalued. But I mean, the PE actually is, for PE really is not. It's really not a bad value. It's not excellent, but it's not bad at all. They give it a buy. They market it as avoid. There's a buy there. Where's the mode? They even have it on it? They have none. Whatever. I'd say narrow, but I hate the scaling of 0, 3, 10. It doesn't actually say that, but none implies 0 to me. Narrow implies 3, and wide implies a 10 in my opinion. So I hate that scale. I'd probably give it a 4 or 5. And what do I know? I'm no expert. Anyways, I think that's most of you can see compared to other ones. I don't even think none of these are American banks, so I hate that comparison. I think they try and go by market cap, but then this makes no sense either. This is clearly not. Anyways, I think that's most of the basics on the stock. So I like it as a dividend stock. If you like it as investment, you agree with Schwab, go for it. There's people that agree with you. I think it's a fine stock. I wouldn't say, oh, you're so stupid for holding it. If it was the only stock in the world, I'd buy it, right? But I think it's a fine stock. So if you made it this far in the video, clearly you liked something in this video, right? So I would appreciate, I'm a new channel, if you subscribed, liked, left a comment, anything like that. But also, if you just made it this far, I appreciate you watching, genuinely. I like making this content. I love talking about stocks. If you like stocks as well, check out some other videos, stick around, subscribe, whatever it may be, because I'm here to talk about stocks, and I'm going to do it all the time, even if no one watches, because I love stocks. I love talking about them. So anyways, I appreciate you watching. I appreciate you tuning in for today. So like I said, leave me in the comments if you have any messages for me, but I will catch you next time. All right, guys. See you later.